Hello and welcome to lesson 5, and in this lesson we're going to discuss low resistance liquidity runs in trending market conditions. Now this is for short-term trading, and with short-term trading we're looking for an average of 1 to 2 trades per week, and we're looking to trade in alignment with our pre-anticipated weekly bias or pre-anticipated weekly order flow. So if our pre-anticipated weekly expansion is bullish, we're looking for a 4-hour or 1-hour buy intra-week, and we're looking to hold for 1 or 2 days, sometimes 3 days, and we're looking to essentially hold in direction of what we believe high time frame order flow or daily order flow should be trading in direction of. Now you're going to get a more specific model for trading short-term time frame and trading this time frame, but this module is to essentially bring the concepts together, and as we get into building a model off of all of these things, that you can understand fully what I'm talking about in terms of utilizing the models to build or utilizing the concepts to build a model with what we're discussing at the moment. Now on the last video we talked about low resistance liquidity runs in consolidations. In this one we're going to talk about low resistance liquidity runs in trending market conditions, which is quite different from consolidated market environment. Now a trending market condition is a market condition that shows a very strong willingness to want to displace to an higher time frame level objective. Now unlike consolidations, which just shows sideways movement and the market gyrates around a mean of a price range, with trending market conditions we don't need to approach price like in consolidations where we're looking for runs and stops because of price unwillingness to want to see very quick displacement. The characteristic of a trending market condition is the quickness of displacement and also the speed of displacement. You generally will see larger candlestick bodies and larger ranges and lesser consolidations in a very strong market condition. So what I just want you to do here is I want you to look at the previous example we used with cable, which is also GBP US dollar, and you can see the lack of willingness to want to see large ranges or large expansions versus look at this recent price delivery, and you can see the willingness in price to not really want to retrace that much or show a lot of consolidation, but wants to show a lot of willingness to show actual expansion. And what's characteristic of expansion is the size of the candlestick body. Now if you look at this consolidation, look how small the bodies are, and look at how larger or how more prominent the wicks are prior to run higher here. So we have wicks back and forth, we have wicks back and forth, another wick back and forth, a long wick here, a wick, a more prominent wick, and then price runs higher for the target objective. If you look at this also small little consolidation, you can see we have a wick here, wick here, wick here, small little candlestick body, wick and wick, now a good candlestick body, actual decent candlestick body, another one, and then price correct, and then a wick, and then a wick, and that is characteristic of consolidations. And you can look at another one here. Is another example. Here you can see wicks and wicks and wicks and wicks and wicks and wicks, and usually the wick indicates that the market at one point was a full solid bullish candle and ended up trading all the way back down for bearishness and then trading back into the mean of the daily range. And that's what I was defining with consolidated market conditions. So they usually are defined with small ranges, large wicks or more prominent wicks, and then classic price action expansion are usually defined with a lack of willingness to want to see deep retracement and a willingness to want to see massive expansion in one direction. So you can see here we have a large body, large body, large body, large body. We have a small little retracement, significant body, less prominent wicks, only bodies, more wicks, a little bit of a body, retracement here, large body, large body, large body, significant body, less prominent wicks, and here you have more prominent wicks here as the market was making a reversal. So you can see what I'm talking about, right? It does not spend as much time trading around the level, but instead within a short period of time the market shows a willingness to want to displace. Now how this idea originated is the run below the low of this range here, and I've taught you this before, and I said once you have a predefined bias Okay, you're looking for higher time frame expansion, and if you remember, we've been calling cable to trade all the way up into and closing all of this inefficiency for a while. When you see a run below a higher time frame low, like a daily low, okay, at a key higher time frame level, and that is occurring at the breaker block here. So the breaker block is these two candlestick bodies, or these last sub candles, price to run lower below the short term low. Then we have a displacement, and then retracement back into breaker block. So that is a discount array. So we have a run on sell stop at a discount. When you see that, again, you don't necessarily need to go in and buy below the low of that. Okay, once you see displacement, that indicates smart money participation, and then from there you already know what the bias is. You're looking for bullishness. Okay, you're looking for trend market conditions. So what I just did here is I built up the idea of what we're going to go next. So we're going to go into another chart of the same JPS dollar but on a lower time frame, using the quarter theory we talked about in consolidation, but this time we're going to approach with the perspective of anticipating expansions on price. Why are we anticipating expansions on price? Because we have a very clear order flow, we have a very clear bias. Now, unlike here, whereby we're already run a stop, so we had a high resistance looking up here, and the market was going gradually higher and higher. Here, as soon as we had to run lower, you already know fund level protective buy stocks were pulling above this daily high, creating a liquidity that institutions are accumulating down here and here and here can be counterparted to, which is up here. Alright, so what we're going to do is we're going to break this down using the quarter theory into a 4-hour range. Now, the range here simply is from the low that starts here all the way up to the high there, and we're using the range to look for ideas. Now, what you can see here, which is key, is that unlike consolidations, you're not looking for runs and stops for trades. Obviously, you're looking for price to align with those same time, which is London session, New York session, and London close for your trading opportunities, right? And you're looking at that to align with your obviously time of the week and your daily order flow direction. That's what you're looking for. But unlike this one, you're not looking for tourist longs. Okay, you're looking for the willingness in price to want to displace. So the moment you see a strong displacement in price, that shows institution sponsorship, and then you're looking for a classic return back into a discount, and you're looking to buy. So if we start here after the run on sell stops here, again, let's define the quarter. All right, so let's do here, and this is quarter one, Q1. We have Q2. Okay. We have Q3 here. And then we have Q4. So we have a first quarter, we have a second quarter, and we have a third quarter, and we have a quarter four. Now, what I want you to watch is as soon as you see displacement, so once we run below that short-term low, and as soon as you see displacement higher, so this is a Friday, right? You see displacement higher, and they look at the return back down here. Are you buying this? Well, not really, because it's a Friday. Even though this is their purpose session, which is London close, and it's a Friday, you're not looking to be a buyer there. Okay, so now what you're waiting for is you're waiting for a strong displacement out of discount. Now you can make the case that a return down here is a good buy on Tuesday here after our sell stops, okay, at quarter one discount. But again, what will be better is strong displacement away from here, returns back down into a discount of this range in alignment with the discount at quarter one. That's a buy right there. Now, unlike consolidated market conditions whereby the market will run above a short-term high and then quickly whip back in the range, with trending or strongly trending market conditions, whenever the market leaves a range, it usually shows range expansion, which is what you don't see in consolidation. So in consolidations, you don't usually see range expansion. As soon as the market trade back trade outside the range, there usually is a 70% chance the market will return back into the pre-existing range. Okay, so that's a very clear difference between consolidated market conditions and trending market conditions. In trending market conditions, price usually shows a willingness on the lower time frame. Now, obviously, we're still trading within the range of this daily time frame, but inside the range of this high to this low, which we've delineated for our quarter theory, the market would usually show a very strong willingness to want to expand and create new ranges. And that's the difference between price delivery program for consolidated market conditions than price delivery program for trending market conditions. So you can see here you have a buy opportunity right there, and this is right at London open, and then the market sees displacement. And then on Thursday, right around London open, again, there's a chance to go long. Now, is this a good buy? Yes. Why is it a good buy? Because unlike consolidated market conditions, we expect the market to see expansion in direction of order flow. So we have two good buys this week. The buys on Wednesday here, then the buys on Thursday here. From, I think we actually called this out. Yeah, we did call this out. I gave this as a buy area, but I told you guys not to trade because it was the day before NFP, I think. So that's why we did not execute on this. But that was still a very good call, right to the pip. But again, the market trades down into a discount area, which is a bullish order block with a mitigation block there, and then sees range expansion as expected. So the time I was doing the analysis, these were the things I was looking at. Again, I tell you, I don't, all the things I look at in price, I don't have to talk about all of them in the even commentary because they'll be like an hour and they'll be too hectic to get through. But these are the confluences I apply on the analysis. And you can see here, this is the discount of quarter two. So I want you to notice how the major buys. Now, sometimes you could get longs at, the premium of the range. But I want you to watch how the major buys do occur. Again, when they're aligned, you don't just go in and say, okay, I'm looking at buys from every quarter one or quarter two. It has to also align with price context within an existing range. Here is a good buy because we've seen very obvious displacement. They return back into liquidity base, which is the bullish order block here. And then with an expansion, here's also a good buy because we're anticipating higher prices in marketplace. And so they return down into a bullish order block with a mitigation block and a fair value gap at the discount of quarter two. So the discount and premium of each quarter is only utilized to support your anticipation in price. Now, you would have seen me do a buy here. I think that was here. The buy you saw me do here on cable was also utilizing this. So again, market goes up into equilibrium. And what did I tell you about equilibrium of the range? A lot of times when the market trades around equilibrium like this, you can see a very sudden. Now, this is not only applicable to consolidated market conditions, also applicable to trend market conditions. You can see sudden run back down into discount. Okay, and as soon as the market goes up in the consolidation, and this is why I tell you when the market gets into consolidation, you have to wait for an action like this. You're looking for the market to make a sudden move against your intended order flow. Once you see that validates your anticipation in price, and then you go in looking for continuation trades. Again, we were looking for buys from here. We know the analysis here, looking for the liquidity up here. And all you can see here, now even though here on Monday the market trades through our discount array down into premium of quarter one, that's not a buy. Why is that not a buy? Because what are you keying off of? So for a buy, you can say this is bullish order block. Yeah, you're keying off of this bullish order block for a buy. But is that a level you want to buy from? No. Why? Because it is at the premium of quarter one. So what does the market do next? Displacement, breaking market structure, going into Tuesday. Right around Tuesday, New York open or New York South session kills on at the discount of quarter two. The market retraces back into bullish order block and sees a little bit of a displacement. On the Wednesday London session, again, still at quarter two, the discount of that does not lose quarter two. Again, watch the bodies, don't watch the wicks. Alright, right at quarter two, it sees displacement for premium, which is this bearish rival gap, which we also called for, and we talked about. Then the market retraces back down here. Now, where is the market retracing back down from? The premium of quarter two. All right, premium of quarter two, intraday scalps, counter trend trade. Again, this is a little bit advanced. You don't want to go in and do that, but again, you can see the significant retracement there. And then going into Wednesday, you can see another, and this is the one we missed, which I think I was pissed off about. All right, during London session, the market starts the expansion for the buy side liquidity we're talking about. And then on Friday, you have a run stop. Is this a good buy on Friday? Is this one a good buy right around the start of London Open? Is that a good buy? No. Why? It is at the premium of quarter three. Is this a good buy here? Yes, this is still London kill zone. This is a good buy there because this is a breaker block running out the short term low, so we can expect a tradable bounce, right? So this kind of quarter two breaker block on Friday, a small little pop higher, and you're done. And then guess what the market does on Monday? On Monday, it expands up into this kind of quarter two. Is there anything you can key off of at discount to look for longs? No. Why? Because you're at premium of quarter three. So any of your discount array, I want you to listen very closely to this. Any of the discount array you would want to reference for longs, they occur at premium. If you're looking for a PD array at discount, you want it to occur at the discount of your quarter. Light bulb movement. Pow, pow, pow. Your brain should be going off right now because this is something really, really powerful. You want your discount array to align with the discount of a quarter. And if you're looking for sales, you want your premium array to align with the premium of a quarter. And you get really awesome trades. Awesome, magical trades. Right? And then look at what the market does on Monday. Because the discount array here, right, if you wanted to look for continuation long or higher, the discount array there is at the premium of quarter three, such as no buy. The discount array here is also at premium of quarter three, so that's not a buy. What does the trade down into? Trades back down into discount. Old inefficiency plus mitigation block plus trade value gap. Is this a good buy there? No. It still is around London close, but again, to Monday, not really that much of a good buy on Monday. And then going into Tuesday, right? Tuesday London session. Do you have any small little retracement you could have bought from? Not really. Market is not offering any trades. Here it gives you a tradable buy at the fair value gap. But is this something you take utilizing the quarter theory? Of course not. If you're not going to take this, what do you do in this situation? You wait for your opportunity to strike. And then on Wednesday, London Open. What are all of these? And what's this? And what's this? That's a short-term low, and this is a short-term low. The market runs below that short-term low, so these are breaker blocks. Bullish breaker block. Bullish order block. London Open. Discount of quarter four. What did I tell you about quarter four? Do not expect significant retracements. Expect high speed, high, fast price delivery, right? Very, very fast price delivery. That's what you're looking for because of the proximity to the target liquidity. The market would want to quickly reach for that target liquidity and pair up orders. And that's what you saw at quarter four on Wednesday. And obviously the market obviously did expand out of the range going into Thursday and Friday. All right, so that, and it also did that off the discount of quarter four. But was that a session? Yeah, right around London Open, trades down there, and then it's this massive range expansion. So, all right, so that wraps it up for lower and liquidity runs in trending market conditions. I will see you on lesson 6. I think we're at lesson 6. Yes, I'll see you on lesson 6. Trade safe.